So when an expat's living overseas, they might purchase a home or some other property, and when they sell that property, how can they minimize the taxes that they would have to pay on that?
There's two ways. First way is to try to qualify for the long-term capital gains tax rates. Those rates are much lower than what we call the ordinary rates. So the long-term capital gains rates are currently either 0%, 15%, or 20%. And those are very large tax brackets. So it takes quite a bit of income to actually get up to that 20%. What is long-term capital gains versus short-term capital gains? Long-term is when you own that asset for at least a year plus a day or more before you sell it. When you do, the long-term capital gains rates apply. Usually it's some sort of investment that you have, or it could even be your own personal residence, not something you necessarily use for like an active business. If you sell it within a year or less, then it's those ordinary rates that apply, which is typically 10% to 37%, and it's a lot easier to hit that highest 37% number versus the long-term capital gains rates at 20%. So that applies to everybody, but being an expat, normally you have to deal with foreign currency issues. You have to keep careful records, and you have to know how much you paid for that asset when you first purchased it. And if it's maybe a home, maybe if you made major improvements to it, you can use that to add to the cost. But you need to know what the cost is, and then you have to consider the exchange rates when you sell it. So in general, it's really just two methods. Try to invest for the long term, so you can take advantage of the long-term capital gains rates, which were a lot lower. And also, to the extent possible, try to manage those exchange rates for when you buy and for when you sell to your best advantage.
When an expat makes a sale on a foreign property and pays taxes in that local country for that, is there any way that they can offset their U.S. taxes on that gain?
Oh yeah, absolutely. And that's done through what's called the foreign tax credit. It's allowed for in the U.S. tax code. And in fact, most other countries that have income tax also have that as well. The way it works is whatever tax that you pay in that foreign country, you can, through the use of this foreign tax credit, reduce the amount of tax you sale on the profit from that sale of that specific piece of property, reduce your U.S. tax bill, hopefully all the way down to zero. You're not going to be paying more than whatever the highest tax rate is between that foreign country and the U.S. Through the use of this foreign tax credit, you will pay whatever the highest rate is. It's just a question of how that is divided between the two countries.